Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in corporate paperwork. And today we've got a doozy that might make you rethink how companies protect themselves in this wild market. So what is the big news from NioCorp Developments Limited today, you ask? Well, it looks like they're rolling out a new corporate defense strategy, a shareholder rights plan designed to fend off any unwanted takeover attempts. Think of it as a company's special shield, designed to make it very expensive and complicated for someone to swoop in and buy them up without friendly negotiations. Before we dive deep, and trust me, we will. If you are someone who loves getting the real dirt on what is happening behind the scenes in the corporate world, make sure you hit that subscribe button. And hey, we've got a fantastic community over on Discord, linked in the description below, where we break down these filings even further. Alright, so NioCorp Developments Limited is the company in question. This report is from the 21st of November 2025, and it's all about implementing a new shareholder rights plan. Basically, the board of directors decided this was a good idea to make sure that if someone tries to buy a controlling stake in the company, they have to play nice. It is not about stopping all deals, but about making sure that any deal or acquisition is done fairly, giving shareholders their due and a chance to get a good price. This document is a Form 8K, which is like a public announcement for significant events that shareholders need to know about, and a new shareholder rights plan is definitely a significant event. The company is incorporated in British Columbia, Canada, and they trade on the NASDAQ under the ticker NB for their common shares and NIBW for their warrants. The core of this is under material modification to rights of security holders. NioCorp's board approved what they call a limited duration shareholder rights plan. The plan officially kicked off on the 21st of November 2025, and it is set to last for 6 months with an expiration date around May 2026. So what does this plan actually do? Well, after a certain date, the 4th of December 2025, every common share will get one right attached to it. These rights aren't immediately useful. They become powerful only if someone starts buying up a lot of the company's stock, specifically if they acquire 20% or more of the voting shares. This is often called a creeping takeover bid, where someone slowly accumulates shares to gain control without making a formal, openly announced takeover offer. When this 20% threshold is crossed by an acquiring person, these rights will then give other shareholders, the ones who are not the acquirer, the ability to buy more NioCorp shares at a significant discount. Imagine if the stock is trading at $10 a share. After a takeover event, you might be able to buy shares for $5 each, effectively doubling your investment overnight, assuming this discount is applied as described. This makes it incredibly expensive for the person trying to take over, because they'd have to buy out all these new discounted shares, or face massive dilution of their stake. It is a way to force them to negotiate with the board and all shareholders. Normally these rights stay attached to your shares, but if a takeover bid occurs, after a specific trigger point, these rights can start trading separately from the regular shares. This makes them even more of a hassle for a hostile bidder. The plan also includes something called permitted lockup agreements. This allows bidders to make deals with shareholders who agree to tender their shares to a specific offer without triggering the rights, but only under very strict conditions. Essentially, these agreements have to be publicly disclosed, and the shareholder must be able to back out if a better offer comes along, or if the original offer doesn't meet certain very specific price or volume criteria. It is a way to allow for friendly deals while still having the protection against hostile ones. Then there are the permitted bid requirements. This lays out exactly what a takeover bid needs to look like to be considered permitted and not trigger the shareholder rights. These bids have to be made to all shareholders, offer a minimum deposit period, and have provisions for withdrawing shares. For instance, a bid must stay open for at least 105 days, or a shorter period if dictated by relevant regulations. This gives shareholders ample time to consider the offer and allows the board to respond. The plan also defines independent shareholders. These are basically all shareholders, except the potential acquirer, anyone acting in concert with them, and certain other entities like employee benefit plans where the beneficiaries don't control the voting. This is crucial because it ensures that the decision-making power during a takeover bid rests with the actual investors, not with those trying to buy the company. And importantly, the plan allows for a competing permitted bid. If one approved takeover bid is on the table and another company wants to make a better offer, they can do so, as long as they follow specific rules that ensure it is also a fair proposal. The board does have the power to waive the application of these rights under certain circumstances. For example, if they accidentally triggered the plan, or if they approve a takeover bid that they deem to be fair. They can also waive it if the acquiring person didn't intend to become one and quickly reduces their stake. However, any waiver that is not for a hostile takeover typically needs the approval of a majority of the independent shareholders. And finally, the board can redeem all these outstanding rights for a tiny amount, like a fraction of a cent, before any hostile takeover event occurs. So they have the power to take these shields down themselves if they decide it's no longer necessary. The plan itself can be amended by the board, but significant changes usually require shareholder approval. Minor tweaks for technical reasons or to comply with new laws can be made without a full shareholder vote. There is also an exception for investment advisors, trust companies, and pension funds who might cross the 20% threshold by managing client assets as long as they aren't actively trying to take over the company themselves. This is pretty standard to avoid disrupting normal investment management. The full details of this shareholder rights plan agreement are available, and it was signed with Computershare Investor Services Inc. as the rights agent. On the same day, the 21st of November 2025, NioCorp also put out a press release to announce this adoption of the rights plan. This is typical for regulatory filings of this nature. And of course, there is the standard interactive data file that most public companies provide these days. So now for my take, this shareholder rights plan, often called a poison pill, is a defensive strategy. It's not necessarily a sign of immediate trouble. But it does signal that NioCorp's management and board are concerned about potential unsolicited acquisition attempts. The company wants to ensure that if there is a change in control, it is on terms that benefit their existing shareholders. The fact that it is a limited duration plan set for 6 months suggests they might be reassessing this strategy, or perhaps are anticipating a period of potential vulnerability. The detailed permitted bid requirements show a strong emphasis on fairness and transparency in any future takeover scenarios, aiming to prevent any predatory moves and ensure shareholders get a fair shake. Potentially a control premium if a deal were to happen. The plan itself, by making a hostile takeover prohibitively expensive, gives the board significant leverage to negotiate the best possible outcome for NioCorp and its shareholders. It doesn't mean they are fundamentally weak, but rather that they are proactively managing their corporate governance framework to safeguard shareholder value in various market conditions. Alright, that is our breakdown of NioCorp Developments Limited's latest filing. What is your take on these numbers, and what they signal for the company's future? Do you think these defense mechanisms are a good thing for shareholders? Drop your thoughts in the comments below. If this analysis was valuable to you, hitting that like button really helps us out a bunch, and of course subscribe for more deep dives into corporate filings. Don't forget to check out the Discord community link in the description for even more insights and discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.